Well, good morning. Again, I'd like to apologise that Warren Hogan hasn't been able to be here today, but I would like to thank you for such a very warm welcome. And I assure you, you're in good hands, we're going to be okay. So just a couple of housekeeping things first of all. As we said, we will have time for some questions at the end, and I'm very happy to take questions. And also the slide pack will be available on the Chamber of Commerce's website later today. So Australia. Australia is often called the lucky country. It is frequently said, when times are tough, we can dig valuable resources out of the ground and generate economic activity, income, and most importantly, growth. And to some extent, that's true. We are a lucky country. We are a resource-rich country. And in recent years, our economy has benefited from the stronger growth in China and its emergence as an industrial powerhouse, and the consequent sharp rise in commodity prices. This chart shows Australia's terms of trade. Terms of trade is a sort of fancy way of saying the relative cost of what we import versus what we export. As commodity prices rallied very strongly, you can see through the chart we had that sharp rise in our terms of trade. In fact, it's been a once-in-a-lifetime commodity boom. And without doubt, our economy has benefited. But now we face an economic challenge, perhaps one of the greatest that we've seen in recent years. The resource boom is over, commodity prices have fallen sharply lower, in some cases are now less than half of their peak rate. The question now is our economy flexible enough to generate economic activity, income, and jobs when we don't have a resources boom behind us? The next chart shows income per capita. So it puts that economic activity, that resources boom, into perspective. And if you look at the bars above 2010, 11 and 12, you can see that we had a very strong rise in our national income per person. And that's reflective of those strong commodity prices, strong exports to China, and the resource boom. Now we're facing a sharply different economic climate. And as you can see, in the last 4 years, the latest of which is 2015, we've actually had falling income per capita. Now, part of that is because the decline in the resource boom has a pervasive impact on our economy. Most obviously, it affects mining investment and mining company profits, but it also affects employment, wages, household income, government tax receipts, government revenue, and the budget. It has a pervasive impact on our economy. And we are currently working through that adjustment. Based on our forecasts, we look for income per capita to be effectively flat in 2016, but then start to rise in 2017 as the transition from a mining economy to non-mining-led growth starts to happen. The good news is the transition is happening. The bad news is it's taking a bit longer than we and policymakers thought it would. Part of that is the adjustments being made more difficult by global growth and disappointment in global growth. This chart looks a little overwhelming, but basically each colour line is economic forecast for any given year. And what it shows us is since 2012, as we've started forecasting into any given year, those forecasts have been downgraded consistently across those years. So global growth is softer than what we thought it would be. Global growth is running at about 3%. That sounds okay, and we expect it to continue to grow at around 3%, but it was growing at 4%. A large portion of that softer economic growth for the global economy comes from a slower China. So that presents a challenge for our economy and actually for the global economy. But it's not all bad news. As I said, the transition is happening. This chart shows the contribution to GDP growth, or the economy if you like, from mining investment in the dark blue line and also public demand, that is government spending, in the orange bars. what we can see is we had a very strong surge in mining investment. A large portion of that is related to those mega LNG projects, but more broadly, as commodity prices rallied, so we invested in productive capacity. And you can see at the peak in 2012, mining investment alone contributed 2.5 percentage points to our GDP numbers. That has turned around, and we are in the midst of a big drag from that mining investment. Mining investment will take $25 billion out of our economy this year, and it took about $25 billion out of our economy last year. Again, though, as you can see from this chart, it's taking time for that drag to move away, but it is getting less, and we are at the peak of it now. More positively, we've also in recent years been in a period of medium-term fiscal repair. That is, we've been trying to stop our budget deficit get bigger. And as a result, in 2014, government demand, public demand, actually took away from our economy. That has eased up slightly, and we're expecting the public sector to contribute to growth this year and in the next 2 years. A large portion of that improvement in public demand has come from public investment and particularly infrastructure. This chart shows some of the major public-backed infrastructure projects. And what we've done is all of the bars that have an orange type hue to them are Victorian projects, and the ones with a blue hue are in New South Wales. So you can see public investment, particularly in Victoria and in New South Wales, will help the economy while we transition from mining to non-mining led growth. The grey bar is the NBN, or the National Broadband Network. So the government sector is doing the job that it can to contribute to growth within the need to maintain a reasonable budget outcome. The really good news, though, is that non-mining economy is starting to fire. And this is the flexibility that we need, and this is what we need to see to fill the gap that's been left from the decline in the resource boom. This chart just shows reported profitability and employment growth for non-mining companies. And you can see that both profitability and employment in that part of the economy has increased and grown strongly in the last few years. That has been led by both business and household services. And you probably hear that a lot when we talk about the global economy, this need to become a more services-led economy. It is happening in Australia. And what that means on a state basis is the states that have services-led industries are performing better than those resource states. This chart shows our own proprietary ANZ Stateometer, where we basically take all of the indicators that we have available on a state level. We run them through a fancy model, and it gives us an indication of whether an economy, what sort of momentum it has. So we have 4 quadrants here. In the top left, you can be above trend growth but decelerating. Top right is above trend growth and accelerating. And down below the horizontal line, we have below trend growth and decelerating, and below trend growth but accelerating. The standout performer at the moment is the New South Wales economy, and that is largely because we are a services economy. We've also had very solid economic activity out of Victoria, which is the dark blue triangle, and more recently, and quite encouragingly, some improvement in Queensland and Tasmania. A large portion of that is improvement in the tourism sector, and that's something I'll come back to in the later. Not surprisingly, in the bottom left-hand quadrant and right down in the bottom is WA, which really benefited from that resource boom and is now struggling to find other aspects of its economy to fill that gap. Despite improved profitability and employment, though, businesses are in no mood to spend. If you go back 2 years ago, most economists thought that we would have a collapse in mining investment and that would be picked up or compensated for by investment by the non-mining part of our business economy, and that's not happening. This chart shows non-mining capex spending, and the black horizontal lines are what firms are expecting to spend in 15-16 and in 16-17. And as you can see, non-mining business investment has been growing less strongly and in fact is expected to fall this year and next year. So I guess the hope that we would get this simple transition from mining investment to non-mining investment isn't happening. Why not? Well, partly it's because domestic demand has been moderate. Partly it's because hurdle rates for new project investments remain quite high and sticky in Australia. But mostly it's because the recovery that we're seeing is services-led. And services industries tend to be more labour intensive than capital intensive. And that's actually what we're seeing. Firms are not spending, but they are employing. The great surprise of 2015 has been the strength of employment growth in the second half of the year. We had an unemployment rate that peaked at 6.3 and declined to 5.8. Now it's ticked up a little bit in the last 2 months, but is still sitting around 6%. So we have had a strong labour market. What this chart shows is jobs growth over the past 3 years based on industry. I'm not sure how easy that is to see, but down at the bottom we have had an absolute surge in jobs in the services sector. Healthcare and social assistance has had the most jobs growth, and in fact substantially more jobs created in health than we lost in mining, which is up at the top. Part of that is from legislative changes with childcare, but most of that is because it's a burgeoning sector of our economy. Other parts of the economy that have been hiring: professional and scientific services, education and training, accommodation, public admin, finance and insurance, and of course those that are related to the property sector, construction and real estate type services. So this is good news. And New South Wales, as I said, is a services economy. New South Wales has enjoyed the spoils of this services-led recovery. The blue line shows employment growth in New South Wales, and the orange line shows employment everywhere else. So as you can see, our economy here in New South Wales is benefiting from the type of recovery that we've got. We are an economy that benefits when we get a non-mining type recovery. But services jobs are relatively low paid. So we've got a lot of jobs being created, but they are not high paid jobs. So what we've done here is looked at average weekly earnings based on industry, and we've put a red box around the industries that have employed the most people in the last 3 years. And as you can see, if you take some of those industries down at the bottom there, you need 5 to 6 hospitality jobs to replace every mining job that is lost. We're about halfway through the retrenchments from the mining sector, so there's more to go there. So it's very encouraging that we're creating jobs, but we need to create a lot of jobs to maintain national income. And if you think back to that second chart I showed you, that national income per capita, that is why that is falling, because we've got this transition to lower paid jobs. So it's critical that we keep employment growth as strong as we can. And weak wages, of course, has an impact on household income. So this chart shows household consumption in the blue line and what we call compensation of employees in the orange line, which is a fancy way of saying we capture all the ways that you earn money and chart that. And as you can see, because of this transition to lower paid jobs, but also because wage growth globally is weak, also because we got lazy during the mining boom and we now need to become more competitive globally, there's a lot of downward pressure on wage growth. So we've seen compensation of employees, or income growth if you like, actually fall in the last couple of quarters. Now consumption growth in the blue line has held up reasonably well. The national accounts that we got 2 weeks ago showed household consumption growing at 3%. That's a little below trend. The reason for that, there's 2 reasons for that. The first one is that households have been reducing their savings levels. Now that's appropriate when income growth is low, but it has a limit to how long it can run. The second one, of course, is that we've had a wealth effect, particularly in New South Wales and Victoria, from the housing market and the very sharp run-up in house prices. This chart shows consumption growth against the average Australian house price. As you can see, it's fairly well correlated. And as you can see in the orange line, we had a very sharp run up in house prices, and that helped to lift consumption growth. But the property market is cooling, most particularly in those states that had the biggest run up in house prices. And what we've put here is we put a little diamond for where we see house price growth in 2016. It's not a dire scenario, but it's certainly not growth for house prices that we've seen in the last year or two. And what we know from history is that spending rarely accelerates when house price growth is moderating. It's not all doom and gloom though. We actually think the downward pressure on wage growth may be close to bottoming. This chart comes back to this average earnings that we saw 2 charts ago. The bars are the quarter-on-quarter change, and the line is the year-on-year change. We had 2 consecutive quarters of a decline in average wages. That's pretty much unprecedented, and again shows you the pervasive impact of the end of that mining boom and the importance of this rotation from mining jobs to lower paid mining jobs. But in the last 2 quarters, we've actually had some increase, and in Q4 2015, a relatively sharp increase in average wages. This is critical to Australia's economic outlook. We need wage growth to improve somewhat, to offset lower house price growth, and to help keep national income strong while we transition to these lower paid services jobs. Also encouragingly, consumer confidence is around its long run average. We have an ANZ Roy Morgan consumer confidence. We poll consumers every week. And as I said, overall consumer confidence is sitting at around its long run average. What I did on this chart though was to drill down into 2 of the questions that we ask consumers when we measure confidence. In the blue line, we ask them about the economic outlook in 1 year's time and 5 years' time. And as you can see, that's been very volatile, particularly in 2016. And that largely reflects the volatility that we've had on global and Australian share markets. But the orange line is when we ask them about their personal finances. And consumers are actually quite positive about their personal finances. So that's encouraging. In effect, you can describe this as, I'm really worried about the economic outlook. There's lots of uncertainty. There's lots of things to worry about. Oh, but you know what? I feel okay about my own income. I feel reasonably secure about my job, and I feel like my home budget looks all right. So that confidence needs to be maintained and actually should lift a bit if we can get a little bit of wages growth and support that all-important consumption. As I said, consumption growth is critical. It's 60% of our economy. Now, one of the reasons it's so important to get consumption growth to accelerate is not just that we've got this drag from the mining sector. As I showed you earlier, that drag is going to lessen as we move into 2017. But in the last 2 years, we've had 2 what we call tailwinds. So if you think of an economy, you can have headwinds, such as the decline in the mining boom, but you can also have tailwinds that push the economy along. And we've had 2 very strong tailwinds. We expect those 2 tailwinds to lessen, and that's why we need private consumption to pick up and move this economy back towards potential growth. The first tailwind we had was the property market. We've talked a bit about house prices and how the wealth effect there helps consumption, but it also, of course, helps residential construction. And what we've seen in this chart, we've got in the yellow line is dwelling approvals, and in the orange line, dwelling commencements. We've already seen dwelling approvals start to roll over. There is actually a very strong pipeline though. We still haven't seen commencements roll over yet. So we think residential investment will remain quite strong for the next 6 months, but there's not much in the pipeline after that. And in fact, we run together with the Property Council a housing construction outlook, which is sort of a confidence indicator for the housing market. And as you can see, that's turned down quite sharply. Certainly, we're not expecting a collapse in this part of the economy, but to contribute to economic growth, you actually need growth. So we think that residential building commencements will remain quite strong in terms of level, but not to continue to accelerate or to have the momentum that it's had in the last few years. And the second tailwind that's lessening has come from the weaker Australian dollar. We know that a weaker Australian dollar makes our products cheaper, it makes our exports cheaper, and certainly we've had some fairly strong export numbers. This chart, though, looks at services exports and how much they contribute to growth. Now, services exports is not something we've talked about much during the resource boom because we've had strong coal, iron ore, and a lot of talk around LNG. But actually, tourism and education are now our third biggest export after iron ore and coal. LNG will overtake that, it will become our fourth, but it's an often overlooked part of our export base, and it's been growing very strongly. As you can see from the blue line, the contribution to our economy from net services trade has been running around its long run average. The peak in 2000 was related to the Olympics. But what we know about this, it's a little bit like the property comment. We think the level of these exports will remain quite strong, but we don't see a lot more downside for the Australian dollar. So we don't see the growth rate in that part of the economy continuing to be as strong as it has been. So again, these two tailwinds, they won't detract from the economy, but they won't propel the economy forward either. One of the things that we do is look at our forecast relative to the Reserve Bank of Australia's. And one of the key differences at the moment is their forecasts to get economic growth back to potential at the end, into 2017, is because they have private consumption growth moving back above its long run average later this year. We think that's a challenge. Our growth numbers for private consumption are somewhat less, and we have the economy not back around its long run average until the middle part of 2017. So what do we do about this? Well, interest rates are already low. Interest rates are already doing their job. We can see that very clearly in the housing and also non-residential construction sector. But there is scope for interest rates to provide a bit more stimulus to the economy. Globally, we've seen several central banks move their interest rates into negative territory, a place that the global economy has never been before. So whereas we thought before zero was the bound, zero's not the bound anymore. We don't know what the downside bound is anymore. We think for the moment that there is scope for the RBA to ease policy again. Not because of what's happening offshore, but because of what's happening onshore. We need this private consumption growth to get back up above its long run average. That requires further employment growth and further declines on the unemployment rate. So for us, the critical question is to be watching the unemployment rate. As I said, it's ticked up in the last couple of months. The question is the peak of that strong employment growth behind us, or is this just a temporary blip? It's quite a volatile economic series. If the unemployment rate remains around 6 or starts to trend higher, we think you'll see some more rate cuts from the RBA. Even if it can get a little bit lower, 5.9, 5.8, we think there's probably still scope to cut. And part of the reason for that is because the inflation outlook is so very low. We've got inflation underlying inflation in the orange bar, sitting right at the bottom, actually slightly below the RBA's target band over the next 12 months. That gives the RBA scope to run this economy a little harder. Now, interest rates aren't the only answer. You need public sector to do its job. You need business to start investing. You need consumers to remain confident enough to spend. But we think this inflation profile gives scope. And at the moment, we've got penciled into our numbers another 2 rate cuts here in Australia. Most likely in May and August, although the risk to that is it gets pushed out a little bit, given the strength that the economy has started with in 2016. And the other shock absorber, apart from fiscal policy and apart from interest rates, is of course the Australian dollar. So this chart has the Australian dollar in the dark blue line. It's a little bit messy. Basically, we run a fair value model that puts all the things that we know impacts the Australian dollar into a model and gives us an idea of where fair value is. Now the Aussie, it's a bit hard to see because of the data, but the Aussie obviously in the last couple of weeks has rallied back up 74.5 this morning, so it's sitting right on fair value. We think if we look at our numbers, there's a little bit more downside on fair value, and we actually think the Australian dollar is in a position probably to undershoot its fair value in the next 6 to 12 months. So we're looking for the Aussie to get back down toward that 68 cents towards the middle of this year or Q3, before stabilising around there and pushing back up towards 70 cents early next year. So to conclude, the Australian economy is facing a significant economic challenge. We've been able to rely on resources, and we no longer can. We need to transition from mining to non-mining led growth, and that's tricky, but our economy is doing it. Our economy is showing flexibility. It's taking time, there are challenges, but we are quite optimistic that this transition will happen, that the peak of the transition happened last year and this year, and that in 2017, our economy will be humming along at around 3.5%. And the encouraging thing for everyone in this room is that the New South Wales economy is doing better than any other economy in Australia. And that's likely to remain the case while we have this services-led recovery. Thank you. So I'll open it up to questions. I'm happy to take questions on anything I've talked about or anything else that you may like to ask.
Joe, first up, thank you very much. It's Joe Risk from the Arab Bank. One of your key slides there this morning was the earnings, wage growth. In your mind, if we compare ourselves to what's happening with the rest of the Western world, I mean, the US has seen very, very little wage growth for the last 8 years. And that's been a bit of a boost for them in terms of becoming more competitive. Yep. So how long do you think constraints on wage growth are likely to continue in Australia?
We think wage growth will remain exceptionally low for a fairly prolonged period. As you said, wage growth globally is low. So if we look at the economies globally that are most advanced in terms of their economic recovery, that would be the US and the UK. In both those cases, unemployment rates are down towards their natural rate of unemployment, certainly there in the UK and approaching there in the US. And in neither of those cases are we seeing any wage growth. And in fact, the Bank of England recently put out a paper that looked at this issue, and one of their very compelling arguments is that post-GFC, workers are not pushing for wage rises. Job insecurity has been high. They talk about this dread risk. Post-GFC, we respond more negatively to bad news over a longer period of time than we respond positively to good news over a shorter period of time. So I think for Australia, there's a few things in that. The first one is wage growth globally is weak. The second one is we got lazy during the mining boom, so our wages are relatively high. Now, a lower Australian dollar helps some of that adjustment, but you need wage growth to remain low for longer to pick up the rest of it. So we don't see substantial wage growth out in that 3 to 5 year period at all. I think the important thing for the economy, though, and the point perhaps I was trying to make, is that we need wages to stop falling, wage growth to stop falling.
Joe, thank you. David Harvey, Shadforth Financial Group. You spoke before about the consumer being so important. The government's also important in terms of infrastructure spend. Yes. And there's that, I guess, conflict between what's popular and what needs to happen in terms of reining in the deficit versus spending on infrastructure. So can you make some comment around your sense as to how that will play out?
Sure. Look, absolutely. I guess when you look at public spending, on the one hand, while the economy is going through this transition, it's appropriate for public spending to play a role in supporting the economy. And the public sector is 20% of the economy, so it's not insignificant. But on the other hand, we also need to rein in our budget deficit and have some, so-called medium-term fiscal repair. So it's a difficult juggling act. One of the very encouraging things, though, I think, is that the spending that we are expecting to see from the public sector is in infrastructure. And for an economist, that's encouraging because that's a productive resource. And we're seeing it in New South Wales and Victoria, where we've seen, particularly in New South Wales, an underinvestment in infrastructure. So that's actually quite an encouraging sign. Also, most of the infrastructure spending has come from a state level, not a federal level. So that's one way that you can nudge and fudge around that medium-term fiscal repair. One of the other encouraging signs, and perhaps you don't see it so much in the community, but if you look at the government's mid-year economic and fiscal update, and we are expecting the same in the budget, what they've basically done is they're trying to curtail some of their expenditure, but they're not trying to offset weaker economic growth. So as I said in that earlier chart, the end of the mining boom hits company profits, income tax, government revenue. They're not trying to offset that by tightening up spending. So in effect, they're allowing that sort of cyclical deterioration in the budget, but not a structural deterioration. I think they have a hard time ahead, and also the Reserve Bank Governor, of course, has been pushing for the fiscal side of the accounts to do as much as interest rates have done for the economy. So it's tricky, but I think it's encouraging they're not trying to offset that cyclical side.
Bert Bardal from EY, good morning. Thank you. Certainly in New South Wales, but I think around the country, Australia has always built less than the demand. So there's always been a demand. The rental rates are very high. Occupancy rates are still at 98% plus. Where do you see that going in the next decade as far as demand for housing and supply for housing balance?
Sure. We're actually in the process of looking at our housing balance model. But look, that's absolutely right. There's clearly been an imbalance and an attempt from a public policy point of view to try and get these economies back on a better footing. And it varies enormously state to state. So obviously, the balance in WA is looking substantially better, and in fact probably in surplus than it was 3 years ago. But if you look at New South Wales and Victoria, we expect residential construction to remain strong, particularly in that multi-dwelling space. And I guess from a sort of economic activity point of view, to contribute to the economy, you actually need growth rates to remain strong. So we see the level of activity remaining around where it is over the next 1 to 3 years, but not any further acceleration in the pace of dwelling commencements and construction.
What's the secret, I think we should call it, keep driving the market in Melbourne, the residential market? All along for the last 3-4 years, we keep saying the whole market is saturated, and yet still going and competing with the Sydney market. Since the bank is based, or ANZ Bank based in Melbourne, I'm sure you got a very close insight about what's still driving especially the city of Melbourne.
The housing market?
Yes.
Yes. Yeah, absolutely. Look, their housing market experience hasn't been that dissimilar really to Sydney. So we've seen this surge in inner city multi-developments, and a large portion of that, of course, has come through investors. Now, we hear a lot about offshore investors, and obviously that's been a significant driver into the property market. And you see that in inner city Melbourne in particular, that foreign investor purchase into the market. And of course, regulation in Australia requires those foreign investors to purchase new property. So that encourages that sort of apartment building that we've seen in Melbourne and also in Sydney. But it's also come about from domestic investors, and that's actually a desirable outcome. We've seen enormous growth in self-managed super funds, enormous growth as baby boomers get close to retirement, looking for capital preservation in their superannuation, and of course, having been burnt from the equity market in the GFC, that cohort look to invest into property quite strongly. So we have seen this sort of investor drive in Melbourne and Sydney. I guess the other commonality that you've seen is in Sydney and Melbourne, you've had this sort of drive into new apartment buildings effectively, but you've also had a drive into housing, standalone housing, in some of those suburbs close to the city, and that's been more in that owner-occupied space, and that's partly a population story. During the resource boom, we saw population growth slow dramatically in New South Wales and Victoria, and population growth in Queensland and WA grow commensurately. And now you're seeing that turnaround. We're seeing a lot of workers coming from those mining states back into looking for jobs, both in New South Wales and Victoria, and so that's created a push of demand.
There's been a lot of talk with the government about reviewing the capital gains. And what impact do you think that's going to have on the investor market? And will it have an impact on the investor market?
Yeah. The answer to that is yes, it will have an impact. We actually don't really know what sort of impact it's going to have. So ourselves and many other consultants have been trying to look through that, and also the government as well. So a lot of that depends on what the final policy looks like, to what extent it's grandfathered. So it's a little hard until you've got the policy, it's a little hard to know what it means. But there's no doubt that negative gearing and capital gains make property an extremely favourable investment. So any change in that potentially has quite a dramatic impact on your property market, particularly in the short term. So I think from a policy point of view, you need to be extremely careful of unintended consequences of any policy that you put in place. It seems to me the momentum behind that discussion and government has waned a little bit in the last week or so. But it's a little hard to know exactly what it does until you know what the policy looks like. So sorry, that doesn't really answer your question, except to say that we actually don't know. It's probably the truth.
Joanne, Paul Van Ross here from Credit Suisse. Just a quick question. I mean, obviously we want average wages to sort of get some sort of inflationary pressure through. Internally, I mean, you can't give sort of any rate signalling or anything like that, but access to credit, do you think it's more of a demand or a supply type issue, speaking from developers' perspective and all those sorts of things?
Sure. Look, access to credit broadly in the economy is not an impediment. So if we look at business investment, where do we have that? And if we look at non-mining business investment, all the feedback that we get and all the data shows us that credit constraints are not why we're seeing this flatlining in non-business mining investment. What we do see is very high hurdle rates for new investment, and that they're very sticky in Australia. So that is that businesses need a very high expected rate of return on any investment before they invest. And a lot of work's being done at the RBA about why that's the case. So it's access to credit for the economy as a whole is not an issue. For the property market, for residential and non-residential construction though, it is increasingly an issue. I don't have the chart here today, but without doubt, lending standards have tightened up, both in terms of looking at projects and in terms of looking at the amount that's pre-sold, in terms of all those elements. There's no doubt that credit has tightened up for that sector. And actually, as part of our, where are we? We do this, let me find the chart. The ANZ Property Council survey, which is publicly available. I've only got here the construction outlook, but one of the things that we ask is about access to credit, and that's shown a clear tightening in the last 2 quarters.
Hi, Joanne. Joel Halbert from CIB Accountants. There's been a lot of discussion in the media recently about superannuation, how much is enough, changing the deduction rules and the like. What's the impact if there's a significant drop in the superannuation pool from an economic perspective?
Well, the answer to that depends on what you do with it. So from a household income point of view, I guess if you can contribute less to your super, do you save that money elsewhere or do you choose to spend it, right? So research would tell us that those approaching retirement will be more cautious and they will spend it in other ways. Save it in other ways. Now that's difficult at the moment, right? There's not a huge number of investment opportunities with a really solid return, but it's hard to imagine that someone getting close to retirement would look to spend what they're not putting into super. And in fact, even if you look at younger people, job insecurity in Australia still remains fairly high. Unemployment is relatively high, so there's lots of reasons to continue to save, whether you save within the superannuation pool or outside of it. In terms of an economy as a whole, I think as long as people continue to save it in some form, it doesn't have a massive, broad global macro. So obviously it has an impact for the industry, funds management industry and super industry and the like. But in terms of economic activity, that money, as long as it's still saved somewhere, is still able to be accessed for productive sort of investment and leverage and those sort of things. So I don't think as a whole it makes too much difference.
Hi Joanne, again from this side. Benbow Coda Capital. Thanks for that presentation. I just feel that we're in a, suppose, global currency war at the moment. Put that in a bit of context. Draghi reduced interest rates last night. Yellen, whether she goes again, questionable. Japan reduced interest rates to negative, as we know. What might that do to, I suppose, the headwinds that we might get from an AUD perspective, go down to 68, which you projected to 70? What I suppose the UK referendum might do in June, July? What the Trump card might be in September, October, and what that might do, I suppose, to the Australian economy going forward, whether you've got any views on that?
Sure. Look, all of those are key significant global events, so all of them have the potential to impact, most obviously through the currency, but actually importantly through consumer confidence as well. We know from our own survey that consumer confidence about the economic outlook bounces around when we see financial market volatility onshore or offshore. So there's certainly some challenges ahead. And there's a lot of uncertainty with these negative interest rates as well. If you look at the Japanese experience, they moved their interest rates into negative and the yen rallied. So a lot of uncertainty about exactly how this is going to play out. How much further can we go? What happens when we try to reverse it, and the like. In terms of currency wars, we've heard these arguments before, generally related to emerging markets, and clearly Japan and Europe are keen to have lower currencies to try and help support their economic recovery, and their recoveries are behind those of the US and the UK. But it's not clear that negative interest rates drive a weaker currency. For the Australian dollar, look, the Aussie dollar, I often characterise it as a fair weather sailor. It's a currency that does well in times of solid global economic growth, partly through that commodity linkage, but partly it's a risky asset relatively. So all those uncertainties are negative for the Australian dollar, but the one thing that continues to hold it up is that our interest rates are high. They don't feel high to us in this room relative to where we've seen them in the past, but on a global scale, our interest rates are high. And so we're continuing to get this portfolio investment into Australian assets, holding the Australian dollar up. In terms of the UK referendum, we don't really have a precedent to have a look at it, but we know from the Scottish referendum that as you get closer, the uncertainty and the polls start to tighten up and become a bit more realistic, you get more impact on financial markets. So it's hard to imagine that the British pound won't continue to feel some downside pressure and probably increasing downside pressure as we head into that poll. It's looking like a pretty close bet at the moment. If the UK vote to leave, that has substantial and long-lasting impacts, not just for the UK, but for the EU itself, in terms of other economies exiting, but just in terms of what their economic sort of makeup looks like. So I think that's going to be a really interesting one. And the US election, look, that's just a watch, wait and see. It's just been a remarkable race, and it continues to throw up surprises. So just a lot of uncertainty for financial markets. Sure. Look, we have a global recession index that we look at, and at the moment it's showing the chance of global recession pretty low. I think it's down around 8% on the current reading. So look, we don't think so. We're fairly positive about the US economy. and we're fairly positive about the UK economy once they get through this uncertainty. So they'll certainly have a slow patch. And even Europe and Japan. So what you're seeing in all these economies is a bit of a stop-start recovery, which is historically quite unusual, but seems to be the new norm. So we sort of think on a global perspective, global growth's running at 3, not 4. We think it'll continue to run around 3. The drivers of that will change a bit, but that 3 is the new norm. So I don't see any of those events in and of themselves particularly triggering recession. I think you'd have to have a series of events underlying all of them.
Hello, Joe.
Hi.
You mentioned 2 likely interest rate movements downward. Not committing the ANZ here, but if we do see those interest rate drops, we're basically looking at another 0.25% drop and then another quarter after that. But are the banks likely to follow with a similar drop?
Thanks for that question. It's one of my favourites. I love that question. Look, obviously there's been a precedent set by banks to not always pass on rate cuts. Now there's a lot that goes into that decision, and for the record, I'm not privy to any of that. What I would say, though, is that banks are facing higher capital adequacy requirements, and the cost of that has gone up. Both, we need to hold more, and what we need to hold has gone up. So we obviously saw major banks last year move on investor loans initially, which was part of this desire to cool the investor market, but then also more broadly on their mortgage rates. And we know when we look at all of the banks that process hasn't been finalised. There's a little bit more cost of capital to cover. Now, there's various ways you can do that. Not passing on rate cuts is one of them. And can I leave it there? Oh, thank goodness for that.
Stock market, BHP 6 months gone down 50%. All the banks approximately 25%. Where do you think it's heading?
Sure. Well, look, we're not an equity house, so we don't have an equity research, but that adjustment is part of the adjustment that the economy is going through, right? So we know that profits of resource companies have been hit extremely hard. Banks are facing different issues, but regulatory issues, increased cost of capital and the like. And of course, there's been a lot of volatility on stock markets globally, so that's sort of been overlaid on the top. But for me, I think if you want to look at the equity market, you need to look at what's firing in the economy to find what's firing on equity markets. And that's services, that's healthcare, that's education, that's tourism-related industries. They're the things where you're going to see growth and increased profitability. And we know that profitability in those industries is rising and rising quite rapidly. We had the chart on. The orange line there is profitability in the non-mining sector. So for me, it's about what's firing in the economy should fire on the equity market.
Hi, my name's Richard Benbow. I'm an environmental engineer. Spent all my life working for manufacturing. I've just Googled something to find out what our current trade deficit is. It's $1 trillion. I've got 8 grandchildren. What does that mean to them when it gets to 2 or 3 or 4 or 5?
Our trade deficit?
Yeah, it's $1 trillion at the moment.
On an annual sum? Well, look, the good news is our trade deficit's going to all but go away, and it's going to be saved by LNG exports, is the honest answer. The first shipment of LNG went out this week, actually, and that will ramp up enormously in the next 2 or 3 years. LNG will become our #1 export. Most of that is contracted, both in terms of volume and price. So despite the fact that oil prices have come down sharply and they tend to lead LNG prices, we will get a boom in exports from LNG. And that will move that trade deficit into surplus over the next 3 to 5 years.
Hi Joe, Adam Malouf from Arab Bank Australia. You've covered economic stimulus this morning in terms of monetary policy rates and also fiscal stimulus, but obviously a subset of the fiscal stimulus is foreign investment. And I'd be interested to hear your views in terms of the part that you think that's going to play in terms of the fiscal side of the equation, and not just in terms of investment in residential property, but big ticket items such as infrastructure, agriculture, and obviously also investment into corporate investment, private equity investment into companies either directly or through listed entities.
Sure. Actually, I was just looking at a chart last week. So M&A activity has been fairly stable in terms of its volume. But we are still seeing, Australia's a fairly attractive place to invest, and it's a lot more attractive at 74 cents than it was at 110. And also, the Australian economy is one of the better performing in the world, right? We've got growth running at about 3%. We've got some challenges, but the economic outlook looks okay. So we've had very strong offshore investment into mining, and particularly into LNG, right? So that's been a massive, majority foreign-owned type investment type projects, and a lot of what goes into building these LNG platforms is imported, comes from offshore, so offshore owned. So look, that side of things will all but come to a halt. We're close to the end of it now. So what replaces it? Well, I guess it's a little bit like the equity market question. I think if you're a foreign investor, you look at what's firing in the economy, and at 74 cents, at 68 cents, stable economy politically, all those things, solid ties into China, solid ties globally, it's a good place to invest, and so there's certainly opportunities. And we certainly see those sort of healthcare services type areas as being sort of the next wave, I guess, of where you'll see investment and where you'll see interest.